You can start if you want to. Start.
Good morning, trading reps. Joshua Tan here, head of research. I'll give you the usual weekly market update on the markets, and Derek Hing will give you an update on any corporate announcements under our coverage. And Travis Xia is going to talk about Suntec REIT today. Travis Xia is our REIT analyst. Okay, so the STI has continued its breakout through the upper downward sloping trend line, which you see here, this red line. And this wedge formation has been effective since October 2010. Okay, so last week we gave a heads up that it was starting to trade through, and that was a bullish sign. And so it has pretty much gone straight up since then, except for some 1 or 2 days of minor correction. Okay, so the area from 3,100 all the way to 3,300 is a messy resistance area. Okay, even in previous, if you look at the even longer chart, there are other resistance lines clumped together in this area, but we do know that it is going through it with relative ease. Okay, so in the broader context, we have further positivity. So, Asia ex-Japan has also gone through a major resistance line and gone through quite convincingly. China, the fundamentals have turned. We have been saying this for quite a few weeks right now, that the fundamentals have turned, and that last week finally we had a turn in the technicals as well. So you can see this MACD bullish divergence in the weekly chart, and we said that if it would clear the 2300, then we pretty much have a quite a good likelihood that it'll head to 2500. If you want to, we think this is probably the best risk reward trade now in terms of market trading, and the CSI 300 can be proxied through 83188.HK or the CFD FTSE China A50. So the A50 is not the CSI 300, but it's trading in a similar pattern. The S&P 500, however, in contrary to Asian markets, is trading the other way. All right, so we've had quite a few series of lower highs, and it seems capped for the near term. As you can see, there's a downward trend line there. Well, mainly due to fiscal cliff negotiations and expectations of Apple coming off. So unless we, rather I want to say that please bear in mind that the larger trend is still very much on the up and is still very much alive. And unless we fall off the fiscal cliff, I think this trend has more likelihood to continue. Short term, we're staying positive but cautiously because the S&P is going the other way from Asia, and of course fiscal cliff downside risk is there. And we'll just give you a bit of a background of where we are right now. I think we've gone through this side called the impasse, right? We've gone through this slide a couple of weeks right now, so I won't go through it again. You can look through the slide, which will be available on MSF, and I think we've emailed it to most trading reps. Basically, Obama has, he's upped the ante because he's won the election quite convincingly. Well, he has asked for 1.6 trillion revenues, which is higher than what was proposed last year, which caused the breakdown in talks. Okay, so right now we are stuck there. However, there's a little bit of progress because although the president has said he will not entertain any cuts to entitlement programs without Republicans entertaining tax increases on the wealthy, finally we actually have Republican leader John Boehner, who has for the first time proposed that he is willing to entertain increases on those earning more than $1 million a year in exchange for containments on federal entitlement spending. So there is some progress. Okay, so longer term, assuming we get a deal, we are increasingly positive on 2013. The outlook, we think, is getting better. We'll reiterate our reasons again. So SCI third quarter earnings were actually in line. Macroeconomic data was quote-unquote weak, but we actually note the positives, which is that the rate of slowdown is easing. China economy is showing signs of bottoming out and could pull the rest of Asia up. U.S. macro outlook is a bit mixed, however. It's a bit mixed. Well, we have good data on housing. Employment is not bad, but below average. Consumption is mainly supported by savings. Investment has been very badly hit by the fiscal cliff, but it could revert on positive news of the cliff. Okay, so we could have a rebound in the U.S. economy if we get past the uncertainty on the fiscal cliff. And also, the Fed has doubled down on QE3. So in September, it announced $40 billion a month of purchases of mortgage-backed securities. At the end of this year, once Operation Twist is over, it will, in addition to that, buy $45 billion of long-dated treasuries a month, and it will keep the Fed funds rate near zero so long as unemployment is above 6.5%. Inflation ahead does not go above 2.5%, and long-run inflation expectations do not unhinge. Okay, so this marks a break from its usual calendar targets, right? It will do something to it's looking to do something until a certain date, but this time it has certain economic targets that if are not breached, it will continue QE3 indefinitely. So we think going ahead there is quite a few positives, and we're getting more positive on the first half next year. Okay, there was a email request on gold. So if you do want us to review certain things, for the webinar, please do email us, and we'll try and address them. Okay, so gold is it's a very difficult asset class to predict because there are many factors driving it, more than most. What we'll tell you now is that the fundamental picture is mixed. Actually, we went underweight on gold, I think sometime in late October, which was pretty much a reversal position from the one we had before, which was overweight. So we went underweight on gold in October, and it was mainly for these reasons. The US dollar is not the worst currency out there. I mean, it definitely beats the euro and the JPY, and these three are the reserve currencies of the world, and the US being the biggest, and it is the best of the biggest. Okay, and that's why gold tends to have some kind of correlation with US, not always, but we do note that it has been the US dollar has been strengthening, and despite all the QEs, because it is still a stronger economy than Europe or Japan, and a strong dollar tends to hold back gold. And also now QE is but on the negative side, QE is the weapon of choice, right? Practically every major G3 economy is practicing or threatening to practice some form of QE, and that's a positive for gold. So you have two forces pulling it back and forth, and so we have gold, which has been flat for over a year now, or rather in a trading range. Okay, for the technical outlook for gold, it's also not clear. It's a big mess, I would say. It doesn't say very much. Given that, on balance, if you were to say, is it a positive chart or a negative chart, I would say it's, unclear but slightly negative. I think markets are actually waiting for the fiscal cliff, right? For some clarity on that. If you don't have a deal on that, that's actually bad for gold, because if you don't have a deal, that means taxes start improving, and the budget deficit is more closed to a certain degree, and that's actually hugely positive for the dollar. Okay. Okay, so for gold, our official position is underweight because there's not a lot of clarity to it right now. I'll pass you over to Derek, who will give you an update on corporate news under our coverage, and then Travis will talk about Suntec REIT. Thank you.
Good morning once again. My name is Derek, equity strategist for Singapore market. Attached in our slides are two relative market comparable tables for our stocks under coverage. So that's just for a quick reference. I'll reiterate our positive view on SATS, SI Engineering, and Capital Land. These are the three top picks in our sector. For more information on them, you could refer to the earlier webinars. I shall not bore you and repeat the same thing once again. Some corporate news for the stocks under our coverage. The first one, SI announced the sale of its 49% stake in Virgin Atlantic. The sale of the stake is worth around Sing dollars $440 million, or around $37 per cent. We think that even though the SI is likely to continue hoarding cash in times of market uncertainties, we think that a special dividend is still likely. And our earlier full-year dividend per share estimates of around 10 cents is probably too negative. If you look at the proceeds, around $440 million, part of it will go into to fund their acquisition of a stake in Virgin Australia. That's around $100 million. So the rest will add to the net cash position of SIA, which we think is really just a bit too much, and the stock and the company could likely return some to the shareholders. The most interesting thing is the market had not responded much to the news. The stock rallied a little bit, but not much. Either way, we think that the stock is still on very cheap valuations, marginally below book. EBITDA multiple of around 3 to 4 times. That is really cheap for an airline stock with such long history and good profit track record. Well, some of our clients actually say that, well, airlines is a bad business. I almost never want to own them. So we suggested you might want to take a look at this. We suggested a sector neutral pair trade back in sometime mid-November to long SIA and short Tiger. We think that is mispricing in the market. SIA is too cheap while Tiger is overly valued at today's price. Our fundamental recommendation on SIA is a buy and sell on Tiger. The next news is that Phillip Properties made an open market purchase of 1 million shares in SC Global, a stock that's under our coverage at $1.81. Phillip Properties holds around 16% stake in SC Global. They commented that at 40 to 50% discount to RNAV, they are unable to find property assets directly at anything like these prices. The transaction price of 181 is marginally above the Simon Chong's offer price of 181. In response, the market rallied to more than $2, and I believe it's still trading above that. Now, our analyst stays neutral on SC Global. Brian is still around inside this room. So if you have questions on this, you could direct the questions directly to him. All right, I'll hand over to Travis, who will take you through Suntec REIT.
Hi, good morning, Trading Lab. This is Travis here. For today, I'll be taking you through on Suntec REIT as we see values in them. For investors with a mid to long-term horizon, they may consider to put Suntec REIT on their radar. What we like about Suntec REIT is that they are currently undergoing a major makeover at Suntec City. The refurbishment is broken down into 4 phases, stretching from June 2012 to end of 2014. For the first phase, which is slated to complete by the second quarter of 2013, was already 71.2% pre-committed. Some of the newly committed tenants include H&M, Paradise Group, Sincere Watch, and so on, and also a new-to-market brand like Thor Lestros. We believe they are on track to achieve its projected 10.1% of ROI and 84% of increase in capital value over the capex. No doubt the rental income for Suntec City Mall will be affected from the asset enhancement works due to a drop in occupancy. However, the management will consider utilizing part of the proceeds from the sales of charms to mitigate the temporary dip in a DPU resulting from the AEI votes if necessary. We think the remaking of our Suntec REIT comes at the right time to stay competitive and relevant. In another 2 to 3 years down the road, we are seeing the formation of mini orchard roads in the City Hall and Marina Centre area. 2 new mixed-use developments, Southbridge, labelled in the third arrow, and the site where the Capitol Theatre is standing, labelled in the first arrow, will be completed in the next few years. These 2 new developments, together with the existing shopping malls and links, will provide a retail and lifestyle therapy to the office crowd and patrons in the areas. Shoppers like us will be spoiled for choice. When we talk about Suntec City, somehow we will associate it with VivoCity, as they are the 2 largest malls in Singapore. So what is the success formula for VivoCity for being a popular shopping destination and superior over Suntec City? First, size does matter. VivoCity is the largest shopping mall in Singapore with over 1 million square feet of a retail space, and this provides a variety of selection for retail shoppers, while Suntec City's mall, the second largest mall in Singapore, is comparable in size, which is close to 1 million square feet. Second, VivoCity is strategically located and is a stone throw away from Resort World. On the other hand, Suntec REIT is situated at the Marina Centre, is also quite close to Marina Bay Sands, connected through a Helix Bridge and a Marina Square. Third, both malls are easily accessible by public transport and well served by MRT stations. So what Suntec City is lagging here is the eclectic tenant mix. With the remaking of Suntec City, we expect a major revamp in tenant mix by introducing anchor and mini anchor tenants and adding new lease of life to the mall. When it comes to valuation, we think that Mapletree Commercial Trust, which owns the VivoCity, is a good comparable for Suntec REIT due to the asset geographical location, where all the assets are in Singapore, and the type of property, as both REITs owns commercial properties, retail and office property assets. At this juncture, Suntec REIT is trading at a deep discount of 18% to its NAV, while MCT is trading at a premium of 24%. We think Suntec REIT valuation is undemanding, even though MCT is related to Temasek Holding with a strong pipelines of property to be acquired from Mapletree Investment Private Limited. In times to come, we strongly believe that the Suntec City is well positioned to capture higher traffic volumes and retail sales and eventually translate to a higher rental income. Thus, we prefer Suntec REIT for its undemanding valuation with an attractive yield of 5.8% at current price. And that's all for me. Thank you.
Thanks, Travis. Okay, we can take questions. Does anyone have a question? Okay, we have a question here. How much cash in terms of cash per share for SIA? Okay, Derek will answer this. Hold on.
Hello. The question is related to SIA. How much cash per share is in the stock? On our projections, by the end of FY13, we expect the net cash position for SIA to rise to slightly over $4 per share. Yeah, that's the answer for the question. Is there any follow-up on that? If there's any follow-up, you could just drop us a question again. Slightly over $4 a share. That's a question. That's the answer. Any other questions? Is the sale positive for SIA? A follow-up question for the Singapore Airlines. I think the sale is positive because it has been an underperforming stake in their portfolio of airlines under SIA. Positive, but if you compare to the high price that they paid, is probably negative. But overall, we think that the cash proceeds is a good time to unlock its hidden value inside SIA itself. So overall, we think that it's mildly positive for them. So the next question is this a good time to buy Suntec REIT, or we wait till the asset enhancement initiatives to be over? Hand over to Travis.
I personally think that it's a good time to buy Suntec REIT now. If you were to buy it after the AI is over, I think it's a bit too late. As the AI is spread out in 4 phases, and there will be increase in DPU over the staggered phases, as when the phase 1 is completed in second quarter of 2013, and I think it's a rather a good time to buy now than later, yeah, because I think it's better to trade at a current low valuations. I think another two questions on Suntec REIT. One, because Suntec REIT has quite a lot of Grade A office hiding building, office building, and its rental respect to correct for Grade A office. For the office sectors market, our outlook is that we expect a drop in 5% in office rent. But if you were to look at the office rental charts, comparing it with 2 to 3 years ago, the current rents is actually higher than 2 to 3 years ago. So we are expecting a positive rental reversion for another year up to 2013. So for Grade A office, we think there's still room for increase in rents, yeah, for at least the next 1 year.
Well, there's another comment actually. It's not exactly a question from the same client. He says today's ST, which I believe is Straits Times, said that SI is a wealth destroyer due to its many failed M&A activity. Also, historically, in terms of cash hoard, what's the percentage of cash to balance sheet? Would SI management be comfortable with? How much beyond this comfort level would they pay out the excess cash? Well, the first comments, I don't think it is entirely fair to say that, because if you are an airline and you aim to grow your business, naturally you have to take on acquisition activities and all that. In the same article that I read this morning, I believe some of the activities, some of the market industry developments that happen post acquisition of Virgin Atlantic are quite unexpected. Like, for example, the 911 incident, as well as the SARS breakout during the early 2000s post the acquisition of Virgin Atlantic. So these are activities that you can't really predict. So in terms of just purely looking at the price that they paid and the price they're getting today, it's a wealth destroyer. I probably can't argue against that. Yes, that's true. But end of the day, if you make a bad business decision, you divest it and you return the cash to its shareholders, I think it's all right at this point of time. At least it's out of a underperforming acquisition already. Historically, the cash hoard, historically, SI has always been in a net cash position. I don't have the number for you at the moment, but typically around $3 billion of cash on this book, in excess of the debt. That's the number. Any other questions? Okay, our analysts for the other sectors are in the room as well, so feel free to ask any other questions. The next question is, STI has been on an uptrend for weeks. Is it due for correction, or will there be more upside in January? Joshua will answer that.
Okay, if you look at if you just look at the charts, then it does suggest that the uptrend is on. And if you look at the fundamentals, it also does suggest that the uptrend is on. But yet again, I mean, you have the fiscal cliff, which is which I would say is a tail risk. And that could always curtail things, okay? However, yes, I mean, for the moment, it does seem that the uptrend is on. It was mentioned SSE is bullish. What are some of the counters that we... Oh, okay, so for the Shanghai Stock Exchange, okay, I'll have to contact our China colleagues for that, and then we can get back to you on that one, because we're not that clued in on the individual stocks of the H-share market at the moment. We'll have to ask our China colleagues. So we can definitely feature some of that to Mr. Roy Yap. We can email you directly. Okay. What do you think of Sing Express? Okay, so we have Mr. Chan Wai Chi here who covers Sing Express. Oh, hold on. What? Oh. Yeah, sorry, we can no longer actually comment on Sing Express because there is some it's on the blacklist already. So which means there are some deals going on, so we can no longer comment on Sing Express. Very sorry about that. Any comments on the healthcare sector? Hold on. Jesus, I think comments. Could you be a bit more specific on question on the healthcare sector, because it's a bit broad. Any comments on the healthcare sector? Oh yeah. Okay. Let's just listen.
There's another question on how about the SGX listed counters. I guess that is asking for the stock recommendations for the Singapore market. If you look at our morning note every day, we actually have a list of the stocks that we actually cover, and our target price and recommendation is listed every day. But within the Singapore market, we have been having a positive view on 3 stocks: SATS, SI Engineering, and Capital Land. These are the 3 of our top picks within the market. Okay.
Hi, Didier, this is Travis here. Actually, we don't really cover healthcare sectors, but if you want to talk about IHH, the result is kind of disappointing. I mean, it's far below the analyst expectation. Yeah. I think this is what I can comment. Oh, sorry. I'm trying to repeat myself again. Because we don't really cover healthcare sectors. In regards to RHH, I think the results for the recent quarter was disappointing, and it's far below the analyst expectations. So your next question is on Rally Gay. I think we don't cover them. I think they have kind of like recover their lost ground a fair bit. Now it's trading at 85 cents. Yeah. But in long term, I think because it's a business trust, so usually investors will give a discount to a business trust. So it's hard to tell whether they can trade above their IPO price. For biosensor, I think we can't comment on that because we don't cover. Yeah. So among the S-REIT, what are the top 3 picks? For myself, I think Suntec REIT is one of the top picks because of the undemanding valuations. Then perhaps you also can look at CRCT because China is bottoming out, and I think the retail sectors for China will also benefit from the recovery. Then another pick I will suggest maybe AIMS, which is also giving an attractive yield of 7%. Also like Sabana or Cambridge is also can have them in your radar if you are going for the high yielding REITs. I think in response to your question on why investors usually give a discount to business trust is perhaps it's good to do with the corporate governance, because I think they will need 75%, at least 75% of voting rights to remove the manager trustees. Yeah, so I think it's kind of hard. So I think they have a bigger say. I mean, yeah, they're bigger say in compared to the ordinary unit holders, and that could be one of the reasons why they are trading at a discount, and also they take on more risk than REITs. Yeah, for example, a property trust, they will take on the execution risk in developing the projects. Yeah, I think that's all I have for the business trust.
Hi, this is Brian speaking. To answer the question on the SGX listed counter that could be benefiting from the rising SSE, actually not really directly SSE, but we are looking at the possibly bottoming out of China. And with that, it's included in our top pick. We are looking at we prefer Capital Land. We think that it could benefit from the China bottoming out. The reason is Capital Land, it's well positioned in the country, and their portfolio also well diversified into the various segments, not just kind of focus on just residential or retail. They are pretty well diversified. So we already picked Capital Land as our top pick on that matters.
Okay, thanks everyone for your questions. Joshua is back. Joshua Tan here again. Okay, I just want to also finally just address on the uptrend of the STI. Okay, although we are fairly positive, I think pay attention to our morning notes every morning, because that is probably the only daily on the ball outlook on the market direction. Okay, so the moment we see technical weakness or something starts to change, we will definitely put it on the morning note. So if you read the morning note, you will have an up-to-date commentary on the STI direction, and not only just the STI, but also the other indices under our macro coverage. Because this is only weekly, right? But you can get a daily commentary on the morning note. Okay. There was also a question on biosensors, but unfortunately we don't cover biosensors. However, we will be reviewing second liners, so I think sometime in January we would probably be able to say something about biosensors. Okay, thank you all for attending the webinar, and research will be taking a holiday break, and we will be back in January for the weekly webinars. Thank you. Bye.